Everything we do here is grounded in our strategy. We are not chasing stories. We are managing probabilities, sequencing, and risk. Our strategy is designed to survive three outcomes: a continued melt-up, a sudden dislocation, or a slow grind into recession. So when we evaluate a theme like defense spending, the question is never, is this exciting? The question is, does this fit our framework, and can it be sized and exited correctly? The video we're reviewing makes a bold claim that a massive shift in defense spending is underway, that money is flowing into drones, AI, missile defense, reshoring, and space, and that a basket of stocks could benefit dramatically. But inside our strategy, enthusiasm isn't the filter. Structure is. This episode is a review and translation of the original video linked in the description. You should always watch the original for full detail and the creator's complete list. What we're doing here is different. We're translating the theme into our strategy: what's signal, what's noise, and how to avoid late-cycle traps. Quick disclaimer: nothing discussed here is financial advice. This is educational and informational only. We're explaining how our strategy evaluates risk, positioning, and timing. Any investment decisions are your responsibility. All investing involves risk. Inside our strategy, classification matters. This video is not a trading plan. It's not a timing framework. It is a theme basket pitch built around assumed fiscal priorities: drones, AI, missile defense, reshoring, and space. That can be useful, but only if treated correctly. The real signal here is not the tickers. The signal is that defense modernization is being framed as a multi-year fiscal priority. That matters because late-cycle markets often reward policy-backed spending, contractual revenue, and themes less dependent on consumer demand. But a real theme can still be a bad trade. Inside our strategy, we assume a theme can be true and still be overpriced. A theme can be funded and still draw down violently during a liquidity shock. That's why defense cannot be treated as one trade. This is where structure matters. Within defense, there are three distinct sub-regimes. First, budget-backed prime cash flows, lower beta, longer contract visibility. Second, program and award optionality, event-driven, high volatility. Third, supply chain and reshoring choke points, small caps, higher upside, and higher liquidity risk. Our strategy treats each of these differently. Homeland security tech is a visible headline driver: surveillance systems, sensors, drones, AI stacks. In practice, procurement here can be politicized and uneven. Inside our strategy, this is treated as optional exposure, not a core anchor. Missile defense spending tends to flow in two directions: toward existing platforms and upgrades, more stable, and toward sensors and space architectures, more speculative. These programs have long timelines. That matters when managing late-cycle risk. Reshoring and sourcing bans can create scarcity premiums, but small suppliers face risks: qualification delays, customer concentration, and liquidity gaps. Inside our strategy, this is treated as high upside, high fragility exposure. Hypersonics, lasers, autonomous systems. These themes are real, but markets often overpay early for prototype to deployment stories. Our framework favors manufacturing, integration, and execution, not just technical promise. Rather than focusing on tickers, our strategy buckets exposure: core defense, cash flow exposure, narrative-heavy AI integration, drone and counter-drone optionality component, and pick-and-shovel suppliers, space and satellite systems, international defense proxies. This avoids treating defense as a single bet. Within our strategy, defense can only live in one place: melt-up participation, sized small, with exits. It is not core capital, it is not crash protection, and it is not permanent exposure. Cash, duration, and optionality remain primary. If defense exposure is used at all, it must be small enough to exit mechanically, diversified across buckets, and subordinate to macro signals. When credit tightens or liquidity breaks, high beta defense sells off with everything else. Inside our strategy, this theme fails if procurement timelines slip, liquidity or credit stress escalates, multiples compress across high beta equities, contract catalysts do not materialize, retail crowding creates asymmetric downside. These are not hypotheticals. They are late-cycle realities. Here's the clean takeaway. This video is useful as a watchlist generator, not a strategy. Defense spending can support melt-up participation, but it does not override liquidity, credit, or risk regime. Inside our strategy, structure always beats excitement. Here's the clean takeaway. We don't chase narratives. We respect sequence, we stay liquid, we size small, and we exit without emotion. We don't need to be early, we just can't afford to be late.